This content is brought to you by iTrust Capital, which is a great platform that allows you to easily invest in crypto without worrying about taxes or fees. iTrust Capital allows you to invest in crypto through an individual retirement account or IRA. IRAs are tax sheltered accounts, which means all of your crypto is tax-free and can even grow tax-free over time. The process of signing up with iTrust Capital is very easy. They have a mobile app. They have 25 plus cryptocurrencies. They have full support, a dedicated team ready to help you. And it is free. And once again, 100% free to sign up with iTrust Capital. There are no hidden fees and there's no monthly subscription or membership. They also have great security. They utilize Coinbase custody for all their custodial services. So you don't have to worry. It is institutional grade crypto custody that they are using. This is a great platform. Once again, it is free to sign up. So visit the link in the description and go check it out. If you sign up with my link, you get a $100 funding bonus. So once again, check the link in the description. Welcome back to the Thinking Crypto podcast, your home for cryptocurrency news and interviews. With me today is Greg Dickerson, who's no stranger to the show. Greg, welcome back.
Hey, Tony, thanks for having me. Good to see you again.
Well, Greg, I thought of you as I know today was the big day with the Fed interest rate hike, and I certainly want to get your perspective as it relates to the impact on the real estate market, stocks, and crypto. So let's start with what were your respective thoughts on the rate hike and the next steps?
Yeah, it's pretty much exactly what he, forecasted, told everybody at the testimonies a couple of weeks ago with the Senate, banking committee and everything. He said what they were going to do. Everybody voted. There was one dissension with the most hawkish member, Bullard, who wanted a half a point rate hike versus a quarter of a point. But he did come out and provide the guidance that we're going to raise it minimum 7 more times by the end of the year. So the expectation is 1.9% in the Fed rate by the end of the year. And, the last time we saw that level was 2018, 2019, and we all know what happened then. So that's the projection right now. And then he also said that we are going to start rolling off the balance sheet at the next meeting. And they talked extensively about that. They're going to actually implement a plan at the next meeting. So that means unwinding the treasuries that they purchased and mortgage-backed securities. So that'll have a big effect on commercial credit markets, real estate finances, stuff like that.
Now, Greg, one of the things people have been talking about is that these rate hikes have already been priced into the markets. And do you believe that given the Russia-Ukraine situation, which could escalate further, and we hope it doesn't, that the Fed may not actually execute on the other rate hikes they're talking about? And this may be a first move, but we'll have to wait and see what they actually do later on.
Yeah, of course, he always says we're going to be nimble and, adjust with the markets and look at the data and things like that. So this is their plan, given current circumstances. What they did say was the economy is strong enough, regardless of the employment situation or unemployment situation, we're going to continue to tighten into this environment of high inflation. They have to tackle inflation, even at the risk of slowing down the economy. So those were kind of the messaging sent to the markets. What the markets, yes. So as far as the markets go, this rate hike was priced in. It was anticipated. What you saw today was a rally on the news that the Fed is going to continue to tighten as they go down the road and fight inflation. So that was good news. It was also a lot of short covering because a lot of people were shorting the market, believe it or not, thinking the Fed was going to come out even more hawkish and that the market would sell off. So you saw a little bit of that, and we might probably have a down day tomorrow in the markets, off of this. So we'll see how it goes. But yeah, this was priced in. What's not priced in is 2%, at the end of the year, and the effects of inflation and a rate hike all at the same time. So that's what's not priced in. A lot of people think it is, but it's not. So, that's another 15, maybe 20% on the Dow and the S&P, definitely 10 to 15%, maybe another 10 on the NASDAQ. NASDAQ's already taken a beating, but there'll be some bounces along the way. And if you go back and look at the history of the bear market activity in stock markets, it looks exactly like what we're seeing. You get these drops, big bounces, drops, big bounces. It's not a straight line down unless you have a big major, event like we had in 2008-9, which was a bank failing situation. Banks were literally failing, so the markets were collapsing. March 2008-9, the economy was shutting down, so markets were collapsing. That's the only two times in my life that I remember circuit breakers, where, the circuit breakers are tripped in the market, they halted trading for everybody to take a breather. I've only seen that twice, those two times that I can remember. Maybe 2018, we might have hit one, but I don't remember that.
Now, with that said, let's talk about Bitcoin and crypto first before we go into stocks and real estate. What's your outlook for Bitcoin and what's your strategy? I know you do short-term trading, not any type of long-term holding. And if you want to share some charts, that would be cool as well. But want to get your perspective and what you're thinking about.
Yeah, you'll have to enable the share screen so I can do that. But, so long term, and a lot of people, it's funny, I looked at a couple of the comments after the last video that we did, and some people think I'm a Bitcoin bear or crypto bear, and I'm not. I'm very optimistic. I'm bullish on everything. That's why I've been able to do what I have been able to do. I've made all my money being bullish, but I'm also cautiously optimistic. I also, analyze risk. I plan for risk and, hedge, so what does that mean? Preservation of capital. So I understand risk. I'm all about preservation of capital. So where you have to look at is where I entered the market. So where I entered the market, there is no long-term, because I'd be down. If I'd have held everything I bought at the time I entered, I'd be down right now. So, I bought a little bit, after the March 2020 crash, but I sold it on the way up. So anybody who's entered the market in the last year, at those $50,000, $60,000 levels, you're down. So that long-term diamond hands thing doesn't work, and given where we're at now and given the environment that we're in. So I made a video the other day and I said, there's really no catalyst to launch, Bitcoin and crypto into the next, stratosphere of 2x, 3x, 10x returns, specifically, and especially Bitcoin, and people say, well, what about on-chain? What about this? What about that? That's not what drives the value of Bitcoin. Liquidity, dollars. You need more capital coming into the space. That's what drives the price. You can have the best on-chain, data out there, which we do have. It's always bullish. It's always good. You have more and more adoption, but what you have is a lot of talk of institutions setting up their trading desks, setting up trading desks. They're not coming in with hundreds of billions of dollars buying and holding. They're setting up trading desks, waiting for regulation and clarity, getting ready to trade the markets. So long-term investors or institutional investors in the space, they're not coming in to buy and hold forever. So they're coming in to trade and get in and out of the market. So when I say there's no catalyst right now on the table to really drive the markets to that 2x, 5x, 10x return, Bitcoin specifically, you need a lot of capital coming into the space to do that. And whales can only manipulate the price so much, and we've seen that. That's why we have been able to crack, 69, 70,000, because there's no appetite up there. And there's a lot of people trapped that once we get back there, they're going to be selling. So that's a very difficult ceiling to get through right now. That's going to take more adoption, more capital, which I do think is coming, and I am anticipating. So, I'm very optimistic that we're going to be at the $100,000 level. Depending on economic environments and where we're at with the economy and with, war and those types of things. So if all things, kind of settle out, we get all that behind us here in the next, few months, we can continue towards probably a rebound towards that $100,000 level. What I don't think we're going to go into a longer sustained bear market like crypto traditionally has, Bitcoin specifically. Altcoins, they've already been decimated. Some of them are probably still going to go down 50, 60% from here. And they might do that thing where they consolidate for a long time and pop later. But Bitcoin's a different animal. And there's more interest in Ethereum. So Bitcoin and Ethereum are the two that are kind of real close, and their charts look very similar, that will probably not go through another 50 or 60% leg down to that $20,000 or $10,000 level. It can happen, and it has happened. March of 2020 went down to $4,500. It might even have wicked down to 3,000 or 3,900, I think. So it definitely can do that. But from a longer term, bear market consolidation, I don't think you're going to see below that $35,000 level that I targeted a few months ago when I said this would be the bottom of this range. I was expecting a retracement, up to a 55, 60, and then roll over and consolidate longer. We didn't get that because we got war and we got, a few other things happening. So that's kind of where my outlook is there. And, if I show that on a chart real quick. So, this is kind of what I'm looking at now in this consolidation. And what I go on the closes. I know a lot of analysts are showing the wicks, but I don't really pay attention to wicks, especially these big ones, because, that's just, short liquidations and things like that. And when you're trading and you put stops out in the market makers see that. They know where they are. So they just wick down and liquidate those stops. So that's not a real price discovery. That's not a real price threshold. So I like to use the closes, and that's $35,000, $36,000, where I kind of said the bottom would be. I was expecting a retracement into that 618,702 level, which is 55 to 60,000, and then roll over and consolidate a little bit more down here before ultimately, going on for a new high. And where I based my projections on a new high would have been, the difference between what we achieved between 64 and 69, and looking at that percentage, because now I think you're going to see lower increments of reaching those new heights, as well as higher increments of reaching new lows. So in other words, I'm looking for higher, lower lows and lower, higher highs as the market continues to get more adoption. You get more sophisticated capital in this space, because that's kind of what they're looking for, more stability. And that's what you see in like the large cap stocks and, blue chips and things like that. You see that, more consistent price action. So that's about a 7 to 10% jump. So, if you take that, price action right there and you say, okay, where's 7 to 10% above 69? And you take that up, that gets you in that $75,000 to $80,000 range. So what I'm thinking, and what I was thinking, you retrace 55, 60, you roll over, you consolidate a little bit more, you make a run up to about 75, 80, then you're going to retrace back to a higher low, consolidate, make a run for 100,000. And that's how I kind of foresee Bitcoin going versus these big, 2, 3, 5, 10x spikes, and then these big drops. I'm not so sure that you're going to see that, in the future, when you're looking at Bitcoin and Ethereum.
Sure. Yeah, it does seem very different than how it's played out historically. And so you're looking at a short-term bear market versus the long, brutal ones of 2018, 2019. And
yeah, I call it consolidation, is what I'm looking at it as. Because, when you define bear markets, in terms of traditional markets, it's down 20% for a sustained period of time. But traditionally in Bitcoin bear markets, 80% down, and you stay down there for a little while for, it's been a couple of years, in some of those cycles. I don't think you're going to see that. I think you're going to see more, of 50% like we've seen, and then it'll run back for the highs, and maybe it drops 20 or 30 and runs back, and just more of a consistent, and ultimately it might just have even a more consistent upward trajectory. But if you look at the Dow, S&P, and NASDAQ's a little different because of, the tech stocks and things. You can get big spikes and drops there. But, the blue chip companies and S&P, you see more of a steady incline with some corrections of 10%, steady incline corrections of 10%. That's normal. A big sell-off in those markets is that, 20%. And you rarely get those because that's traditional bear market territory. So I think as Bitcoin becomes more mainstream, you get more institutions in there. That's kind of how the capital works. And the reason it works that way is because if you think about the way Bitcoin works, and what I'm talking about is what's driven it to these huge exuberant peaks has been network adoption and retail investors coming in that euphoric frenzy of everybody running in. People think institutions are going to FOMO and do the same thing. They're not going to do that because they have to manage risk. They have to manage risk. They can't do what a retail investor can do. And retail investors are price goes up. That's it, never goes down. So what happens is it drives till it hits a peak where people the risk reward is too high. People stop buying. So then it, rolls over and it drops down. In the past, it's been these, huge euphoric, parabolic moves and then a blow off top. Now it's a little different because of the capital that's in the space where you're getting more of a distributive top, that Wyckoff distribution. You're getting more of a distributive top versus the blow off top. And you have more sophisticated capital. So the retail investors are already out by the time you get there. And then a lot of them are kind of coming in up there versus coming in down at the bottom, back when price was $100, $1,000, $5,000. When price is 10, 20, 60,000, that's a different level of individual taking that kind of risk reward. Now the public, the retail investor that normally drives that parabolic move has seen 64,000 tank, 69,000 tank. They're like, I'm not willing to take that risk. So you've got less appetite wanting to come in at that level. And the asset allocators out there, the institutional investors that have to allocate, what I mean is they have to put money at risk. They have to put money in the markets because they have a payout. So that's life insurance companies, pension funds, hedge funds. They have to make returns, to investors and to, their beneficiaries. So they have to grow. So they have to constantly allocate. Well, they have to maintain a certain risk profile. So they can't buy Bitcoin if there's a 50% drawdown risk. They can't. It's against their chart. So they're not allowed to do that, just like they're not allowed to allocate but a certain percentage to risk assets. Most of them can't allocate more than 5% to risk assets. Good news is there's, $100 trillion funds that can, right, allocate 5%. That's why you see these billionaires allocating 1%, 2%, because they're following the same kind of thing. It's risk reward. So until Bitcoin starts to level out and starts to act more consistent, which it's doing, and you get regulation around the space in general, then that money can be allocated and they can raise their allocations. And then you'll see what, the rotation of capital, because they're only going to be able to be, exposed maybe 5%. So once they get to that 5% allocation, they will never be able to expose their portfolio to more than 5% in that category. Then there'll be so much in stocks and so much in bonds and so much in treasuries and so much in, these other things. That's how the institutional investors work.
Great perspective on that. And as far as stocks, I know last time we spoke, and you're not so much invested in stocks, but if you were to take a position, what is your strategy right now? And I know you probably don't want to give away your secret sauce if you want to call it that, but how are you trading it?
Yeah, it's kind of the same thing. So I'm in and out, and I've been working on these moves here lately as the market's been hitting these. So I'm waiting for the bottom. I'm waiting for the all clear in the markets. And again, this recent rate hike was priced in, but the effects of what we're dealing with aren't. So we still have some more downside to come before we see a bottom. Some people are already saying that the bottom's already in for this, but I'm looking at the beat up tech stocks that I think have future, have earnings, good companies, but aren't Facebooks, Amazons, things like that. I think Amazon has some more downside. Netflix. I mean, these companies that really aren't going anywhere. I'm waiting for them to get back to normal valuation levels of, 14, 15 forward earnings and things like that. Some are still trading 18, 20, and 30. So I'm looking at some of those and kind of picking those up and hitting 20% moves here and there before I'm looking for more of a long-term rip. And until we get the war behind us and we understand where inflation starts to curve and roll over, and we start to reverse inflation and the overall strength of the economy, that's when I become more long-term. And, that's where I can become like more long-term in some stocks, maybe a little bit more long-term in Bitcoin. I just don't, Bitcoin to me is there's just not exponential upside right now, until we get more, clarity in the space and, we can see where that goes. And then altcoins, they still have some rips, here and there with some of those. And, there may be a rotation in that category, still waiting for the alt season, which I think we already saw, after June, July, the same time Bitcoin was doing that irregular correction. So the first retracement was, after that June, July low, when Bitcoin retraced, it was right in that 618 to 702 level. And then it went to 69 afterwards. That was an irregular manipulated correction, I think. And the altcoins ran at the same time. And a lot of them hit the extensions that they should have hit, 4236 extension from the last cycle peaks. And they've all been downhill ever since. So that could have been the alt season. But there's still some coins that are ripping here and there, but they're not all going, right. And Bitcoin hasn't run again yet either. So if Bitcoin does make another run and then roll over, then, then the altcoin should follow behind them. And that's where you could get, some 10Xs in there. So I'm kind of waiting, and until then I'm just in and out, striking here and there. And, and again, what a lot of people miss is like days like today, when the markets rebound, you go up there, a lot of people are going to long that move. Okay, well, that's where you short. Yesterday at the bottom, when we were at the bottom, that's where people are shorting. That's when you need to be longing. So, that's where I'm at. And most people do the exact opposite. When a market tails off and hits the bottom, they're wanting to short that for more downside when you should be going long. When the market's up, people want to long for more upside. That's when you need to be shorting in a bear market. That's where we're at right now. We're not in a buy the dip continuation market. We're in a bear market. Stocks, traditional markets, price discovery bear market phase. And a lot of people think price discovery is only on the upside. It goes both ways. The other thing is sometimes the best trade is no trade. Sometimes the best offense is defense. And I'm playing defense right now. So, I'm in preservation mode, catching these rips, buy the dip, sell the rip kind of versus on the way up, you can buy the dip, buy the dip, buy the dip. You don't have to sell the rip. You wait till it rolls over and you sell the rollover.
Yeah, I'm the same way. I'm just watching and seeing where things are going, not really taking positions. I've been swing trading some things like you're saying on the crypto side at least, and making some profits there, but not much. I've certainly slowed down a lot. Okay, let's talk real estate. With this interest rate hike, what is the impact on the real estate industry, and what is your respective strategy? As much as you can share. I know that's your business, that's your baby. So
nothing, no, there's no way too much. So, rates are going up. So that's driving mortgage rates up. So in the residential sector, everybody's buying payments, most people. So a lot of people are paying cash, and there's investors buying houses. But the average owner occupied house, they're buying a payment, just like a car. You go in the dealership, you don't care what the car costs. You want to know what your monthly payment's going to be.
Yeah.
Houses work the same way. So as interest has gone up, so has the payments, for those houses. So it brings the affordability down of what somebody can buy, which ultimately is going to affect the price on houses. So we're already seeing that impact. So you're seeing mortgage refinances kind of go away because rates are over 4% now, and that's where it starts. It starts at 4% because of where we're conditioned in terms of what we think good rates are and the people that are coming into the market. So it starts with the refinance market. That's kind of dying out. And, the purchases, people are, number one, there's lack of inventory, lack of choices. Prices are at all-time highs. So that's starting to roll over now. We're starting to see, days on market go up in some markets. We're starting to see inventory climb in some markets. There are others that are still just wide open and red hot. And, once rates start hitting that 5% plus level, and if the Fed funds rate gets up to, 1% to 2%, that's when rates will be 5 to 6% in that range. That's going to do a lot of damage to housing, to the housing market. And generally it lags about 6 months. So it could take 6 months to a year for housing to catch up with what's going on because of the affordability. I don't know if we talked about this last time, but if you can, based on a mortgage, at 3% interest rates where we were, your mortgage would be $474,000. Of course, you had to put 20% down, but what your payment at a $2,000 a month payment, if that's what you could afford, your mortgage is $474 at 3%. At 4%, it's $418. Goes down $60,000. At 5%, it's $372. $100,000. It affects the value of what you can borrow by $100,000. So that reverberates through the housing market. And the last people to adjust to that are the sellers, right? The retail, owner occupant seller, because it takes a while for that psychology to shift in terms of what they thought their property was worth. And, if they don't have to sell, then they don't, because they still think it's, going to be worth more. And it takes a while for them to adjust into a devaluation of the value of their house. But builders, that's the group that can sell. So if anybody's looking for a house, what you want to follow is the builders that are building subdivisions and developments that have a lot of inventory, because when they stop selling homes and things change and they understand what's happening with interest rates and values, and they do because they've all been through it before, they'll start cutting their inventory and they'll start selling because they already have a built-in 20-30% margin anyways. Right. They can already sell for 20 to 30% less. That's the first sign. And when you see them start to cut prices and liquidate inventory, then it trickles through to the resale market after that. So, that's the residential market. In the commercial market, it's the same way. You're buying cash flow. And, the property has to maintain a certain debt service coverage ratio. And, you can only put so much down on that if you're raising the capital from investors, because you have to pay that back. So, the value of commercial properties are greatly affected by interest rates. So the higher the interest rate, the higher the cap rate, traditionally on properties, the lower the interest rate, the lower the cap rate, because you can, it makes it more affordable, just like housing. So it works the same way in commercial markets. And, there are a lot of short-term interest-only loans in the commercial market out there right now that are going to reset at the end of this year, next year. And if the rates are up at 5-6%, there'll be a lot of people that are going to be forced to sell because it won't make sense to refi at those rates. at the end of that cycle. So it'll be interesting to see what happens.
Now, with all these things said, the markets are down right now. Real estate could take a hit and so forth. Powell said they don't really have an expectation of recession or not too worried about it. Do you think we got some hard times ahead of us over the next year?
It's possible. So recession is just a decline in GDP for two consecutive quarters, negative GDP for two consecutive quarters. So that's not a big deal. You could be negative 1 or 2% for 2 quarters, and that's a recession, right? Technical definition. So typically inflation affects the people's ability to buy, because more things cost, the less money you have to spend. We're already seeing that at the gas pump, grocery store, things like that. At the retail consumer level, which is what our economy is driven by, the consumer. So as our purchasing power declines because of inflation, well, that's going to affect growth, okay? So the less we buy, the less the economy can grow. Now with inflation, it's kind of a false mirror there, because prices have gone up. Sales can stay higher and profitability can go up a little higher because you're raising your prices, but your cost of goods is going up. But the theory is, as interest rates go up, the cost of credit and borrowing goes up, which a lot of people use to consume: credit cards, loans, HELOCs, things like that, equity lines. So that gets more expensive. You can borrow less, so you have that happening, the cost of credit. It gets harder to borrow as rates go up. Credit markets tighten, so they're more restrictive on who they lend to. The consumer can buy less, so theoretically companies will produce less and potentially start laying off. So those types of things can happen. What the Fed is saying is they're not really seeing that because the economy is strong. There are still more jobs than there are people willing to take them. And they think that they're going to be able to get inflation under control this year. They still think they are. So we'll see, because we're coming out of the pandemic, although China is still going into it and they're having a big issue. We still have the war, which is driving energy and food costs, which we're not going to see the impacts of that till the end of this year, going into next year, with fertilizer, wheat, agriculture, and then livestock, because a lot of that, grain is grown to feed livestock. So that, and Ukraine's already had to, kill off a lot of their livestock that would normally flow into the food supply. So there's a lot of trickle down that takes, 6 months to a year to filter through. So we'll just have to see, where things shake out here in the next few months. It's really hard to tell now, but, could we see a decline in GDP for 2 quarters? Possibly, but it's just hard to say right now, given the current environment.
For sure. Greg, always insightful information. Thank you so much for joining me today.
Yeah, it was great to be here. Thanks for having me.